Diversification across asset classes is a strategic approach to achieving portfolio stability, reducing risk, and enhancing long-term returns. By allocating investments across equities, fixed income, real estate, commodities, and alternative investments, investors can benefit from varied risk-return profiles and reduce correlation risk. For small apartment investors, incorporating other asset classes into their portfolios enhances overall risk management and provides opportunities for balanced growth. What is asset class diversification? Asset class diversification involves spreading investments across various types of assets, each with unique characteristics, risk profiles, and return expectations. The purpose is to reduce dependency on a single asset class, minimizing the impact of market-specific risks and volatility on the portfolio. For example, a portfolio that includes stocks, bonds, real estate, and commodities is less volatile than one concentrated solely in equities or real estate. So equities have some unique characteristics like high potential for capital appreciation, but they're also subject to market volatility. When you look at the risk-return profile, it's definitely higher risk, but with the possibility of higher returns. In a portfolio, equities typically serve as the growth driver and, they're really important for long-term wealth creation. Now, fixed income or bonds come with their own set of characteristics. They provide stable, predictable income streams and generally carry lower risk compared to equities. The risk-return profile here is lower risk with moderate returns. In a portfolio, their main role is income generation and honestly, risk mitigation. Real estate is a bit different, offering tangible assets that can provide rental income and potential appreciation. Plus, it tends to have a relatively low correlation with equities. The risk-return profile is moderate risk, but you get stable cash flow with the potential for capital appreciation. In terms of portfolio role, real estate is great for income stability and serves as a solid inflation hedge. Commodities are tangible resources like gold, oil, or agricultural products, and their performance is often inversely correlated with equities. They tend to have a higher volatility, but they can also provide inflation protection. In a portfolio, commodities serve as a source of diversification and can act as a hedge against economic instability. Alternative investments, such as private equity or hedge funds, are non-traditional assets that offer unique return opportunities, though they're typically less liquid. Their risk-return profile is varied, with the potential for high returns, but also higher risks. In a portfolio, these alternatives can provide diversification and help enhance risk-adjusted returns. Portfolio stability, is all about balancing those performance fluctuations across different asset classes, which leads to, more consistent returns over time. Risk reduction means basically decreasing your exposure to any single market or economic factor, so you're not putting all your eggs in one basket. Correlation risk mitigation happens when assets with low or even negative correlation work together to reduce your overall portfolio volatility. Enhanced risk-adjusted returns, in simple terms, means optimizing your portfolio's Sharpe ratio by, improving returns relative to the risk you're taking.